And I say so many stupid things, and if they're recorded, well, then there's a more accurate picture of me that emerges.
We noticed the poster on the way in saying index investing is un-American.
Now, that came out in 1976 when the fund was underwritten.
Yeah.
And it was not popular, and with the people in the industry.
Yeah.
And I have in a speech I gave in Boston now, just going in as an article in the Journal of Portfolio Management, and I talk about the day that will live in infamy for mutual fund investors, and that's the day in 1958 when the Supreme Court allowed management companies to have public ownership. You could sell your management company. You could capitalize by selling your fiduciary office. And that was a catastrophe. And that gave rise to this industry basically being taken over by conglomerates, with just a few exceptions. Vanguard, Fidelity is still private. American Funds is still private. But you go down the line, and it's just... And why does a conglomerate buy into this business? They buy into this business because they want to earn a high return on the capital they put into it. And guess what? In this business, you can earn any return on capital you want. Funds grow. It's a gold mine. And they've made so much money on it that you can't even believe it. Sun Life has taken $4 billion out of Mass Financial, which I think they only paid about $300 million for in the last 15 years. $4 billion. And so that's the day that will live in infamy for mutual fund shareholders. But the day that will live in infamy for mutual fund managers, you're getting the point here, is December 31st, 1975, when the first index fund was incorporated.
Yeah.
And that's not to be confused with today. Yesterday was Vanguard's 39th anniversary. But we the first thing we did was start the index fund. But without Vanguard, there wouldn't have been an index fund. Because everybody, as I've often said, everybody had the knowledge, the ability to do it, but nobody had the motivation to do it.
Yeah.
It was not a particularly novel idea. The way we did it was a novel way. The index we chose was novel. The way we got around all the regulatory things was novel. It was not a slam dunk, but it was close. So a lot of other people claim they started the first index fund, and I said, well, where's the fund? Where is it? And I look around there. I don't see it. Well, it vanished somewhere. So we know that that's the first index fund, and that required a Vanguard to start it. So and so you have the yin and the yang. And the obvious thing about this business is it's in general fair to say that what's good for the manager is bad for the investor, and what's good for the investor is bad for the manager, because it all comes down to cost. And to give you a little further, you didn't ask this question, but let me make sure you get this platform. Mm-hmm. And that is 100% of Americans are indexers. 100%. How did that happen? Because 100% own the entire stock market, right? So there are those that choose to own the stock market by owning it share by share in the market weight, but 25% of the market, and they don't play games with each other. They don't have transaction costs. They don't have management fees. And the other 75% obviously owns the stock market, right? That's all there is left to own.
Yeah.
It's a tautology. But they own it by competing with themselves to see who can do the best.
Do you think there's truth to what Joseph Stiglitz said? It was similar to what you just said right after the financial sort of crisis, and the dip was coming back after the sort of floodgates opened from the Fed. And he said, just because the stock market's going up, don't think that's a good thing. He said sometimes what's good for the stock market is bad for America, because I guess at that time the stock market was going up on the backs of Goldman Sachs and all the financial people recovering.
No, I don't agree with that. And I don't agree with that because I think the stock market is, in a way, just a fool's game. The stock market, as a speech I gave to some academics, in all places in Bermuda, where I never did get out of the hotel, it's there for 24 hours, is the stock market is a giant derivative. derivative of the value created by corporate America in this case. And it over-reflects that value and it under-reflects that value. But its value is derived from those, the earnings and dividends, the ability of corporations to compete, the idea of competition, the idea of capitalism. Sometimes it goes awry, but in general it's trying to build a return on capital, make some money, plow it back into the business, start something new, kick over the old traces of the old, if you can, if you have the courage to. That's another problem. People don't like to do that. But there's a business out there in the U.S., and it's proved to be very successful over a long period of years. Sometimes I don't like business so much, but the stock market either reflects that or under-reflects it.
Yeah.
So, I don't know why it would be good or bad. Do you follow me?
Yeah, it's just a window.
It's just the price you're paying for that value.
Do you think public equities will exist in 20 years' time? When you look at their sort of, they kind of ebbed and flowed, but in terms of their...
That's really a good question. And I don't think anybody's asking it. That makes it an even better question. And obviously, our whole business here at Vanguard is staked on the fact that public ownership will continue. I don't see that there's much of an alternative. There are a lot of firms that would like to go private. The number of firms, don't hold me to this exactly, but there used to be a Wilshire 5000 index, and now that's now been incorporated into I guess it's the University of Chicago index, whatever that's called. It's CRISP. Yeah. And it's not called the 5000, but it's the total stock market index. And the Wilshire 5000 at one point had 7,200 stocks. And the Wilshire 5000, you have to check me on this, now has about 3,500 stocks. Yeah. Half of the stocks have gone. A lot of that was in the idiocy of the information age boom, the new era. There are no new eras. I mean, not that the internet hasn't changed every single thing we do and every way we deal with it. It's unbelievable. Okay. But probably, I'd take a guess, I think maybe even conservative, that 90% of the internet companies that were created are gone. Yeah. And, that's true of the automobile industry back in the 20s. Used to be, I think the number is 431 U.S. automobile companies. And now we got General Motors and Ford. And if you want to count Chrysler, although it's an Italian company. Yeah. And I don't know who the other one is. But there's been a huge winnowing out. And actually, that's one of the things that, I don't want to go too far in this, but worries me about the way capitalism is working. It's Adam Smith writ large, making more and more, bigger and bigger pin factories. Yeah. And the economies of scale are there, but size has brutal implications. And you see it in your neighborhood stores. Walmart comes in, all the hardware stores and that kind of thing go out of business. And they're merciless competitors. And you say, well, that's capitalism. Out with the old, bring in the new. But that does have strong implications for the kind of society we have. So yes, it worries me, but I still think public capital, the value of the U.S. stock market today is probably, let me just guess, it's $17 trillion. And it has had a very consistent relationship with GDP over the years, and it's not a good long-term test, but in the short term, by which I mean, say, 15-year periods, it's if it gets way out of line with GDP, its market's probably too high, although it may take years to reconcile it. But you look at the chart, and you can see it's a pretty good market timing chart. Yeah. And but you can't really use it to market time because we're all so impatient to be out of the market when it's going up for 2 years. You finally say, well, I blew that one, I get back in, and that's the day, of course, it hit its high. Yeah. The market is a very behavioral-oriented. Hope, greed, and fear remain the rules. So, but I think there's always going to be a need for public capital. And I think we grotesquely underrate the role of federal government capital. Here, all these big shots can't stand the federal government doing anything except bailing out their businesses. I mean, really.
Yeah.
So forgive my cynicism,
Yeah.
but I think the record will make it clear and will validate that.
I had a question. You haven't been asked this in all the interviews I read before, but it speaks to the GDP. And so GDP, I guess, was created around the Second World War to measure industrial production. And Kuznets said, whatever you do, don't use this as the value of the whole economy. Of course, that's what everybody did because it was a useful, comparable measure. But it doesn't. Some people have said GDP isn't a fair reflection of economic activity because there's a lot of off-balance sheet items. So if you go and take oil out of the ground that's worth something, all of a sudden that shows up on GDP, but nobody's deducting anything for the economic rent or the depreciation of an asset that's finite.
Well, yeah, let alone ruining our environment.
Yeah. Do you think that there's a role for GDP to have a fuller encapsulation of the value and liabilities?
I think I'm sure there have been a lot of changes in the way we calculate GDP. I mean, I'm not an expert on it, but I don't look at a piece of government data without a fair amount of skepticism. And cost of living is another really interesting one.
Yeah.
And that's one of the things that's killing Social Security, because we did not use cost of living. We used wage increases to give to retired people. And that has to be changed.
Yeah.
It has to be within reason. And so, give me a piece of data, and I'll say, let's give me a half an hour with that, and I'll give you a little lecture about it. Data is always, I don't want to understate this at all, always flawed. Is it flawed badly? Is it flawed conceptually? Is it flawed mathematically? It's a product of, I think Lord Keynes talked about this, the ideas of some dead economist.
Yeah. Lies, damn lies, and statistics. In terms of your book, The Battle for the Soul of Capitalism, you outlined some challenges, and then you brought up some ideas just in the interview about size. You talked about things like the idea of enough. There's sort of other people talk about the planetary existential challenges of 9 billion people, climate change, to the resource scarcity, those types of things. But when you sort of go to bed or wake up in the morning, you're thinking about, because you're in your life, you've tackled the big issues. What are the sort of few things that kind of really stick where you think, these are the things that we've got to crack as a species if we're gonna have a go at it in the next 100, 200 years?
Well, the enormity of those challenges is so great that it's far beyond the ability of any individual to, for the want of a better word, intellectualize. And the unpredictability of how they'll come out is another. There certainly can't be any doubt left about global chaos. It seems to be more chaos than warming. Yeah. You can see it out in Colorado. You can see it with all those hurricanes that we got ready for and haven't had one since. Mm-hmm. Katrina must have been in about 2008, I guess, something like that. Yeah. And everybody got ready for them to get worse and worse and worse. And, of course, they got better and better and better. The unpredictability of climate is quite something. There's a drought here and a flood there. They've never seen rain like that out there in Colorado before. So basically, I kind of take it as it is, as I said in this talk in Florida. If you think about the number of hazards, I think this is the riskiest time to invest that I've ever seen. And it's not just a question of the alternatives are so bad. That was my point about a year ago. And that is to say, if it's a risky time to invest, you would go to bonds as a haven. It's awfully hard to see if bonds are going to give us 2.5% or 3% over the next 10 years. And from this day forward, that's about what they have to give us. Even with a lot of governments in there that drag the yield down, I don't think that's good statistics. It's another very good example. And to depart a little bit from the question, and that is we take for granted the bond market index, Barclays, I guess it's called still, is a good index of the bond market, and it is a perfectly terrible index of the bond market. You look under the surface, it's 72% governments, and you look at who owns all those governments, and I think of 16 billion, China and Japan and maybe a little bit of a few other countries own 8, is it 6 billion of that? Some huge number that are irrelevant to U.S. investors if the idea is to do better than your neighbors. And then a lot of them are quite short-term. That's not really bond. Yeah. All the very short-term stuff is out of the index. So, I have had a little campaign here to start a corporate bond index fund.
Oh, that's a good
Because I
idea.
don't think the average person should be 70% in governments.
Yeah.
I mean, the yields are terrible. I don't see, what you have to think about in the bond market, which has always been a great interest of mine. Even when I told my former Boston partners that we ought to start a bond fund, and I got this note back saying, "You don't understand. Bonds are yesterday and stocks are tomorrow." I knew the great crash could not be far away. And so the math should be that if the premium is 1.5% corporates over governments, that you should expect a 1.5% default rate, and they should be the same. There's no such thing as a free lunch. I don't think that rate's going to happen, and none of us know that. And I would certainly talk about high quality bonds. I don't like to fool around with quality on the bond side.
Yeah.
And nor do I really like to fool around with it on the stock side, although it's a little harder to measure quality. So, that statistic of the bond market is basically fundamentally flawed. And we look at it as if it's the truth every day. And so all bond managers were morons, of course, during 2008, and all bond market managers were geniuses in 2009. How did that happen? I mean, they were the same people, weren't they?
A rapid increase in IQ, sort of like the Russian decrease in mortality after Gorbachev.
Yeah. And you can play with these numbers, and I do a lot of gamesmanship with numbers, I admit that. Done it all my life. But I'm basically trying to make more sense out of it than what you see on the surface. So you have a bad alternative is one reason the market is very difficult today, difficult time to invest. And then you have, things like global warming an unknown threat. The way I expressed it then at this speech was diseases which don't respect national borders, bird flu kind of thing.
Yeah.
Nuclear war, you can't put that aside. You see it kind of creeping up on us. Widespread religious war.
Yeah.
To say nothing of dealing with the religious war we have now. These little tiny pieces here and there. There's really, when you think about it, no defense against tribal kind of stuff, religious kind of stuff. Getting us into a lot of trouble. And then you might think about what are the chances the meteor is going to strike the Earth. Now, in that case, it won't matter whether you're in stocks and bonds. You heard it here. So I guess I finally come out as basically a careful optimist, as saying what I said in the speech, that whenever you look, the world's about to go to hell in a handbasket, but somehow it never quite gets there. So if you want to argue this time is different, it'll get there. Who knows, maybe you're right. But let's assume that things will, that even if something really bad happens, or these risks do not go to hell in a handbasket. See, you're the warrior, and you want to do something about it. Well, the only thing you can do is not invest. Don't put your money to work. The choice is basically digital, yes or no. Do I invest or do I not? I think for anybody with reasonable resources, you have to invest for the future. You can't throw yourself, particularly the roughly half of the U.S. That is able to deal with investment matters, that has the resources to, maybe less than half, and they have to put money away for their future.
What do you think about the barbell strategy, where you take, say, 10 or 20% and go super high risk, and then 80% to super safe? Do you think for somebody sort of in the sort of mid-30s with a 40 or 50-year horizon, is that safer with better returns than just a straight indexing, do you think? Or?
Well, the answer to any question like that is always it all depends.
Yeah.
What you're doing with the risky portion.
Yeah.
But to say that you're going to buy a whole lot of, a great example would be buy one of those stupid ETFs that has triple leverage.
Oh, yeah.
And I can imagine I might be able to imagine a stupider decision than that, but I'd have to spend a long time thinking about what it would be. Am I okay here?
Yeah.
Yeah.
Am I being too honest with you?
No.
No. I totally agree.
No, Doug is a devout Vanguard investor and disciple of index investing.
Yeah.
So when we look around, like there's firms who benefit in the system now, and you in your speech, in one of your convocation speeches, you talked about the idea of enough and how the financial markets have kind of went from 6% of profits to, well, at the height of the financial crisis, 40%, and they're back to 35 now. And this at Goldman Sachs is sort of maybe an unfair poster, ambassador of the sector. But what do you think, if you were global head of strategy for Goldman Sachs, or you own 100% of it, what's their business in 15 years? Like, you think of information being free, almost China coming into play. What, the Goldman Sachs exist in 15 years in its present form, do you think, or standing in the middle, just collecting big fees?
Goldman Sachs honestly has a real problem. They're going to sit there and tell you that the secret of their success is putting the client first. Okay?
The Muppets?
I'd say let's test that. Let us look at the Goldman Sachs mutual funds. And I have in Clash of the Cultures a ranking of the 50 largest mutual fund managers. They're probably among the top 20. And they're ranked by the performance of their funds. And it's a very fair system. I don't think it can be, nothing is perfect, but I just take the number of percentage of their funds that have 4 and 5 star funds, good, and the number that have 1 and 2 star funds, bad, ignore the middle, and subtract. So Goldman Sachs is minus 40. Vanguard is ranked second. I think they're third from last or fifth from last. There's quite a crowd down there at the bottom, close to each other, in big minuses, 35, 40, even 50. I think maybe one of them is. And Vanguard is going to be at the moment we're number 2 or 3, and that's primarily because T. Rowe Price had a very good period, and I'm absolutely confident it won't go on, but still that's what it is, and I can't hide the fact in my book, and so we're say plus 50 and they're minus 50, just symmetrical. Maybe it's plus 45 and minus 45, and then go over to the cost line that I show there, and we're lowest, and they're not quite the highest. We come in at, I think, in this study about 25.25, and they come in at about 135. Okay, if they wanted to put their clients first and reduce their expense ratios to the industry average, let me say 90 to 100, they would all of a sudden go up to be average. And if they want to get to where Vanguard is, and we clearly put the clients first, although this place is so big, I'm not sure we do it as well as we should or could, but it's no question the final numbers are what they are. And they could be in the top 15. But their fees would have to go down from 130 basis points, 140 basis points, to say 25. That's putting the clients first.
Yeah.
What's it say? Do you think that's on their agenda? Do you think anybody at Goldman Sachs says, I hate to tell you guys, but we're blowing it. Look at the data. We're among the worst performing fund groups in the entire mutual fund industry. And we're going to hurt our reputation in the long run. But they still have the mystique. The funds really are not particularly good, but they're not particularly bad either. They're just too damned expensive, and so that gets carried down to the bottom line of the fund's performance, the higher cost. So the financial industry has to put clients first. Ultimately, the clients are going to understand all this, and they'll probably blame it all on me, by the way.
On American indexing.
On American indexing. It's hard to get across the compounding mathematics, which are staggering.
Yeah.
I've heard, if you follow my stuff, the secret of investment success, long-term investment success, is not allowing the miracle of compounding of returns to be overwhelmed by the tyranny of compounding costs.
Yeah.
And the costs are going to take around 70% of your returns, 65, 70% over your investment lifetime.
Yeah.
What's really the point? You put up 100% of the money, you take 100% of the risk, you the investor, and you get 35% of the return, or 30%, or 25%.
Yeah.
And people will start to realize that, not through compound interest tables, unfortunately, because they should know it right now, but through their own experience. And they look, and I hear from investors with great frequency still, and almost more than I can keep up with in terms of correspondence. And they understand it for themselves. I left, fill in the name of the brokerage firm here, smartest thing I ever did. And one guy who bought into Vanguard S&P 500 at the market high in 2007 and said it was the smartest thing I've ever done in my life. Mm-hmm. And someone said, how about people that got burned in the crash? Well, there was no reason to get burned in the crash. The stock market is, counting dividends, is 25% higher than the previous high. Mm-hmm. And if you were a little conservative, following kind of a balanced Bogle thing and bought Wellington Fund, you're 38% higher now. The reason you got caught in the crash was not the market, it was you. Mm-hmm. You panicked and got out.
Yeah.
Now, I don't know how many people did that. Nobody knows that.
Yeah. I know Vanguard has not really strayed from market capitalization weighted indexes, and I personally believe strongly that that's the way to go, but there's a much more academic evidence now pointing to the merits of so-called fundamental indexing or smart beta indexing. I'm just curious what you make about this new type of weighting securities and how that compares to the simplicity of market cap weighting.
Well, I've been arguing with Rob Arnott about it for about 7 years.
We've spoken to Rob as well.
Yeah.
And first, if he's not the greatest salesman God ever put in the face of this earth, I don't know who is. He is truly a great marketer. He's a very, very smart guy. Mm-hmm. And if my success comes out of being not very smart, it's going with the market as it is. It's easy, mm-hmm. And it works. And the issues are pretty simple. First, I'd answer your question clearly. I don't believe it is durable. We've gone through long periods in the market. I have a little chart that I use. So often it's called the Bogle chart. And that is to give me any set of performance numbers. And I divide the cumulative return. Take one performance number doing this and this, and divide it. And then another showing the S&P 500, and then divide one into the other. So if it's going up, you're outperforming. It's going down, you're under. I do it with growth and value. And everybody knows that value is done better. But they ignore the fact that there may be 20 years when growth does better. How many investors are going to have the patience to do it for 20 years? And it's inevitable. This is not, growth and value go back and forth. I started the first growth and value index funds in 1993. And 20 years later, they have given the same performance. The growth fund got way ahead, 93, 99, early 2000. And then the value has been pretty much ahead, way ahead in the shock that came, just reversing the other trend. Mm-hmm. And so nothing is durable, in my opinion. And don't be deceived. Even if somebody takes the longest time span they can find data for, it is what we call period dependent. Mm-hmm. They don't pick the period as such, but it depends on the period. Mm-hmm. So you take a bunch of other periods and try and see how it works. And sometimes it does, and sometimes it doesn't. It is not without considerable logic, but it implies that the markets are inefficient, which I'm the first one to agree. They often are. But what I told Rob finally was, it's going to go back and forth. I can't. The 2 points I'd make are, we can guarantee you the stock market return compared to what everybody else is getting. Your neighbors, all stockholders as a group. That's what market weighting is, telling you how you'll do compared to how everybody else does together. Rob's theory may even be better, but why do you want to take the risk? Maybe he'll do better for quite a while. I don't think so, but it could be. Anything could be. And maybe he'll do worse. So can't you be satisfied with the market returns? And I think that will ultimately prove to be the better strategy. Mm-hmm. Number two, I tell Rob that if everybody adopts his strategy, then that gap that he sees between fundamental and whatever, market weighted, I guess, will vanish. So if he wins, he will then lose. But he would say you're going to make a lot of money along the way, which is obviously true. Mm-hmm. But I just, things new come along. People have their own motivations for doing them. And he looks at me and he's going to say something like, yeah, the problem with Bogle is anybody that has a good idea is going to be very resentful when anybody comes along with a similar but better idea. Remains to be seen. I don't care from that standpoint. We could start a value-weighted index tomorrow. Mm-hmm. And for all I know, maybe we will. I don't have anything to do with that. I would not. The bandwagon effect is, very painful to investors. And by the time it gets so painful that we have to start one to compete in the marketplace, always a bad idea, it'll all be over. The pressure gets more and more intense as the gap gets bigger and bigger. And I think maybe he's ahead by, let me say, a percentage point annual return for the period he's run his fund. But he's going to show his institutional clients that he's been doing this since 1993. This is all on paper.
Yeah.
And I don't pay any regard to that. And the reason these guys bring out these funds, whether it's Jeremy Siegel or Rob, is you can't bring them out when growth is at an all-time high relative to value. And Siegel has this in a chart that they used at the beginning of his thing. And you can't do it when the chart's down here. You do it when the chart's up here. And so they did it about 3 years after maybe 4 years after the market peak, and then that big collapse in growth stocks relative to value stock took place in around 3 years. And then value has done up and down since then, but not dramatic. And so, to each his own. People want to buy it. It's not a terrible idea. First, be very clear on that. It owns the same stocks we do.
Yeah.
The weightings are different, mm-hmm. and it may work and it may not. But I'm just not too much into May.
Yeah. I think Rob would probably accept that if he wins, he loses in terms of the market being there. What if this is a bit of a hypothetical, but it's an attachment to reality. The first part, though, is what if you had insider information about securities the rest of the market didn't have, and you use that to inform a fundamental reweighting strategy? In that, if you had actionable, valid insider information, would that?
That's a little too much if for me. Who could possibly be in that position?
Okay, well, so the insider information isn't quite as juicy as there's a merger coming, but there's been a big dump of data into the marketplace over the last 7 or 8 years. Most of it's unaudited, and a lot of it's messy, and it's around environmental performance, so things like spills or energy use or water use. And now about, if you look at the 4,000 mid-caps globally, about a quarter to a half of them are reporting this data at regular intervals. And if you test it, you can see that in certain sectors, not across the economy, but say in the energy sector, spills will be linked to landing in an alpha bucket over a 5-year period. And then there's a plausible causality mechanism in that BP lost a lot of value, just so you can sort of see. You don't know for sure if that's the cause, but you can sort of see the plausible mechanism and the empirical data linkage. And the rest of the market, the data is kind of a mess. It's new. They don't know how to clean it. They haven't figured out how to clean it and apply it. It's going to happen. Maybe it'll take 5, maybe it'll take 10 years. But in that intervening period, people who can do that could have a sort of insider advantage if they, if they applied it to securities. I guess there's some risk, but in that sort of narrow instance, you think the fundamental strategy might make more sense?
I don't think that is what I would call inside information.
Yeah, no, it's not. It's not illegal insider information, but it's sort of information the rest of the market hasn't figured out how to clean and apply.
Well, I'm never so sure about that.
Yeah.
I don't accept that on face value. I have to think about that a little bit.
Yeah.
You're talking to one of the world's great skeptics.
Yeah, no, we have a lot of regard for your skepticism. Yeah.
I guess my question would be, do you think there's room in the market, even theoretically, to start to incorporate so-called extra financial data into product development?
I'm really skeptical about that. And I read Keith Ambachshire's stuff,
Yeah. Oh,
Yeah.
yeah.
and
He's one of our advisors. Yeah.
and I just don't see
He said to say hi, by the way.
the proof that
Yeah.
he's a really good guy.
Yeah.
And I sometimes get exhausted in those bulletins because I read them all, but they seem to say the same thing every week.
Yeah.
Yeah. It might be.
Yeah.
And he's proving something that may not be provable. Data can only be taken so far.
Yeah.
And he does it with integrity. Of that, I'm certain. But and this may be a place where I'm just wrong. Everybody's always giving me hell for not saying you have to have international in your portfolio. Well, that's the way I feel. I feel that for a whole bunch of, I think, pretty obvious reasons. And almost nobody disagrees with me. And I say, okay, go to 20% if you want to. It's not going to kill you. But don't go over that because I don't like the sovereign risks. I don't like the currency risks. I don't like all those kind of risks. And just to go down the litany, first of all, when you buy the S&P 500 or the total stock market, these companies are getting 50% of their revenues from outside of the U.S. and 50% of their profits.
Right.
So it's hard to think of America as being some funny little domestic provincial country. The risks on the other, so you're already international. Do you want it to be more or less? That's a legitimate decision. And then one of the worst ones is, I know that's true, but foreign markets, I emphasize the word markets, fluctuate differently than the U.S. market.
Yeah.
And the one thing we know about that correlation between foreign and U.S. Or non-U.S. and U.S. is, number one, the correlation used to be about 35, and now in the past 10 or 12 years, 10 years, it's been 80, 85. In other words, are they looking at the old data or the new data? And which one should they rely on? If you want to prove there's a high correlation, look at the last 8 years. If you want to look at this, there's a terrible correlation. You get a lot of extra diversification. You look at the earlier period.
Yeah.
You can. I don't think the argument is very sound, to be honest. So you look at all that, and then you realize the ultimate statement is the one thing we know in the past, and we have to be careful about that, is international diversification lets us down just when we need it the most. When you get a crash, believe me, the U.S., sneezes, and the foreign markets get pneumonia. And but why are we talking about markets and correlations? What does that have to do with the price of eggs in China or something? In the long run, suppose that you could have let me just say for the top of the head, a 10% market return with a, see if I can try this, with a 12% standard deviation. Or you could have an 11% return with a 13% standard deviation. Wouldn't everybody take the higher return? What does a point of standard deviation mean to the average investor? And that's sometimes the kind of definition with the kind of different differential that we're talking about. So I think it's overdone. It relies too much on the markets. And then I say, if I still haven't made my point, look at the stocks that dominate the international index. Start with Great Britain. They're hanging in there, but not much more than that. Look at Japan. This absolute rigid society, even before the tsunami, with unbelievably bad demographics. And then go to France. France. They don't work in France. I'm hyperbolizing here. Don't mean to offend anybody.
No.
But when you think, why would you rather be in France, Great Britain, and Japan than in the U.S.? I wouldn't. Now, that's a judgment. Could I be right? Could I be wrong? And in a way, it flies in the face of my idea that markets are relatively efficient. Markets are in fact, relatively efficient in that they are priced to reflect people's opinions about the future. And in the long run, it's going to be growth rate that takes national growth rate or corporate growth rate that's going to call the tune. And so, it's an ambivalent kind of an argument. But to each his own, and I don't think it's going to matter that much, and I wouldn't do it. One interesting thing, by the way, I want to come back to fundamental a second, is that Jeremy Siegel, who's funded by, who's the big hedge fund manager in New York, very successful. His company was, and they're making a lot of money now.
Yeah.
How is their dividend-based fund? By the way, I like the dividend-based fundamental investing, if I'm allowed by Arnott to call it that. How you can get a patent on the word fundamental is beyond my comprehension. And he actually got in a lot of trouble in court. He had to pay a big fine. I don't know if you've read any of that or not.
I didn't know that. Yeah.
He really didn't tell the truth in his court testimony. And the court assessed him a $900,000 fine for trying to take on somebody who had the same idea, apparently the same idea. And if you go back and read my stuff, back way into the early 90s, maybe even the 80s, I'm talking about fundamental return, meaning earnings and dividends, dividend yield plus earnings growth, and specifically, and speculative return, meaning market valuation or impact of a PE change. And but wisdom tree, with this, I think, reasonably acceptable idea. At least you can compute it. Add up all those dividends and weight them by that. And if a dividend goes down, you've got to change the portfolio. It should have higher turnover. But anyway, it's no worse an idea than Arnott's. But if you look at Wisdom Tree, God knows how much they run in the way of assets. And I would guess to you that no more than 5 to 10% of Wisdom Tree is the fundamental dividend index. It's commodities.
Yeah.
It's a whole lot of, fruit and nutcakes. It's just the kind of thing people shouldn't pay attention to. My opinion.
Yeah.
I can't help but notice you have a copy here of Fortune.
Oh, is this the original copy?
Yeah.
And I know that when you were at Princeton, this is precisely, I'm guessing, the magazine. Maybe not the.
Yeah, somebody gave that to me the other day.
Okay. I just think that's really neat. I know that you read, you happened, by coincidence, happened to read an article in the mutual fund industry back in 1949, and that really crystallized your thesis and then your entry into the mutual fund industry, and then by extension, the foundation of Vanguard, which I'm very grateful for since I've owned Vanguard products for a long time. My question is, do you think there's room in the market for another leap forward in the same way that index funds and ETFs represented a great leap forward back in the early 90s? So if there was a young Mr. Bogle today, for instance, and he's looking, scanning the horizon, what do you see as sort of the next great wave in terms of product innovation in the financial markets?
Well, first place, probably one of the major liabilities of the financial system is innovation. Because we're innovating to find new products that we can sell to investors. We are innovating to enrich the purveyors and not the buyers. We may think we are trying to do that for the, but nothing happens unless somebody makes a sale in the securities business. So those tigers, hungry down there in the cages, need raw meat thrown at them. And so we have new pieces of raw meat. My favorite example of that was when Merrill Lynch, in the spring of 1990, introduced an information age internet fund. At the same time, they introduced a top 20 stock portfolio kind of thing. It was very popular then. If you got, why would you have 100 stocks in your portfolio? Just get rid of the 80 that you like the least and hold the 20. Neither of these things proved to be innovations that helped investors, to say the very least. And they did a couple of $1 billion in that underwriting. And everybody lost money except you-know-who. And they may have ultimately lost money because of the disenchantment of their clients. I don't know that. But it was a disgrace. And, there's so many innovations that have come along that give a bad name to innovation. I'm, of course, most familiar with the ones in the mutual fund business. Putnam brought out a government bond fund that I learned about when I got an envelope in the mail, a direct mailing, and it said, "How would you like to earn 12% on a government-guaranteed portfolio?" And I thought I would like to earn that a lot, because the government yield was 6%. And I looked at the small print, and it said, "Quarterly yield annualized includes premium and capital gains, premium income and capital gains, and you annualize it for the quarter. That's how you get to 12." A totally flawed proposition. And the fund was a catastrophe. It got to be, I think, the largest bond fund in the business. Mostly old people who needed more income. And the income ended up dropping 75%, and the price of the fund share dropped 65% or something like that. Innovation, well, you've got it already. First the innovator, then the imitator, then the idiot. And I think we should skip the imitator phase in some of those. But it's all over. And collateralized mortgage obligations are the same thing. The idea that you can put these things into some sort of a tranche, which someone was told me was a French word for sewer. I don't know if that's true or not, but it does sound right, doesn't it? Trench?
Yeah.
And that's what came out. And it was a fundamentally flawed idea. And we were living in a world where you couldn't sell anything that wasn't A or AA or AAA rated in the way of bonds. And so you massaged the books, the bestowing of benefits on those various tranches. And some of them actually worked out okay.
Yeah.
But it took a long time. You had to wait and wait and wait. But the innovations, I'm with Paul Volcker, who said the only innovation in the last 25 years that he thought was useful was the ATM.
Oh, yeah.
And I asked him when they had that party for me on Wall Street a couple of years ago, a whole day hearing how good I was, Legacy Forum, Bogle Legacy Forum, sponsored by Paul Volcker and Arthur Levitt and David Swenson and some pretty darn good people. Probably the best we have in this business. Alan Blinder, Bert Malkiel, had all, I think, 4 former SEC chairmen there. It's a lot of sponsorship and a lot of nice things because what we have in the innovation of an index fund is, I would argue, and I have argued in my speeches, the gold standard.
Yeah. And
if the index fund is a gold ingot, and there is in fact no systematic way, because the new innovation, that's a little redundant, isn't it? Because the innovation is something that's better, and that is it can in effect guarantee you more than the market return. Nobody can do that. It's just impossible. Or I should say much more easily that everybody cannot do that.
Yeah.
Or it can't be copied because all of a sudden everybody is beating the market. But everybody is the market. I mean, this comes home to roost when you realize the limitations. So the idea is to get your fair share of the market return. The index funds deliver that, and I don't see anything else that does. Paul, by the way, agreed with me that if someone had said, "What do you think are the most useful innovations of the last 40 years?" he would have said the ATM and the index fund.
Yeah,
so I had him on record on that. And so that was an innovation that was done. Why was it done? We were tiny. Had to do something. We wanted to get into the investment management business, and we weren't allowed to by our charter in the breakup of the company. So when I presented this to the board, they said, "You're not allowed to get into investment management." And I said, "Aha, this fund has no management."
Just tracking the index.
Yeah.
A little shaky.
It worked, though.
And it worked another year later after that, and we went no load.
Yeah.
And they said, "You're not allowed to get into distribution." I said, "We're not getting into distribution, we're eliminating it." And so we got rid of the entire dealer network that we've been working with for 50 years. So innovation is by and large a great thing anywhere in an economy, but as far as I can tell, the field of finance. And the field of finance is bloated. It's doing 30% of the market's earnings, I think, now. To what avail? It's all a subtraction to what lies in the ultimate security, which is the value of all those corporations, their stocks and their bonds, together, certainly. And and is Arnott's thing going to erase all that? I doubt it, but I don't know. How could I know? But I'm content to go where we are. And I see an awful lot of innovation. When you think about it this way in terms of a gold ingot, why the heck is this industry going around creating all those lead ingots? And you know the answer to that, because they want something to sell.
Yeah. What if we put a constraint and we say innovation, or not? Let's not call it innovation. Let's call it evolution. That's another loaded term. But not evolution premised on creating more fees or more middlemen, because that's usually what the evolution has been leading. So that's off the table. It's about fees getting lower and less middlemen, sort of like what you did with eliminating the dealership network. And we try and solve two problems, which is always tricky than solving one. One problem is like, how do we get the best proposition for investors? But if we want to solve two problems, we say capital markets is probably the most powerful force on the planet today. Equities in particular, 50 trillion. I think relative to GDP, it's about 1-to-1 ratio. So 50 trillion GDP, 50 trillion equities. And if we went back in time to when you started your first index fund, equities were about 25% of global GDP. So the equity markets have become 4 times more important as a percent of global GDP. So I think it's pretty safe to say that capital markets are a powerful tool. And at the same time, we have these huge challenges where we have to sort of start to flow more capital to more resource-productive firms if we're going to meet this sort of challenge of 9 billion people on the planet of finite resources. But the investment markets weren't built to solve these kind of long-term, non-financial problems. They're built to solve financial return.
And the mortgage is just a way of accessing corporations.
Yeah.
And let me just do some. Hey, Sarah, do you want to ask Michael to come in a sec? I'll give you the GDP thing from my perspective.
Okay.
I don't do so much global.
Yeah.
I don't know kind of how to manage that and measure that with confidence. I don't have much confidence in any. Hey, how are you? Did you meet these? Michael
Not
Nolan, my
officially.
assistant.
Hi,
Doug Morrow.
Doug. Pleasure to meet you.
Toby. Yeah.
Toby, how are you?
Yeah.
They're having quite a grilling here, and we got talking about GDP in the market.
Okay.
Could you get me my GDP in the market chart
Sure.
and my book value in the market chart?
Okay.
Okay.
No problem.
But you're right. It's an important thing. But, it basically is so overwhelmingly more important than it should be. If you're investing forever, there's really nothing the matter, although very few people are going to be able to do it, of owning the U.S. stock market, or you can say international flavor if you want to. Doesn't really matter. Then holding it forever, never peaking, never buying and selling except sending in your little check every month. Mm-hmm. And you won't believe how much money you have after 50. You open the last statement, and you fall over dead, proving that you didn't need to save anything at all in the first place.
Yeah.
And the markets get in the way of that. We talk about these crises, mainly led by ETFs in these market failures. The one in May of, 2011, 2012? I guess it was 2011 or 2010. And it simply doesn't matter. It mattered to a buyer or a seller, but to a holder, it's like a little hiccup. And if he forgets to get his Wall Street Journal, everything gets, in those cases, everything got back to normal valuations within, 24 at the most, 48 hours.
Yeah.
And if they didn't, there were a lot of opportunities for stock pickers. So I will answer the question before you answer. Do you think we're going to have a stock pickers market? There is no such thing.
Yeah.
Because when I pick good, you, the seller to me, pick bad.
Yeah.
And when I pick bad, you pick good. So it's all steady. People don't understand the market is a closed system. We're betting that we're smarter than our neighbors and paying a lot of money to if we just stay even, which is the most you can really hope for.
Yeah.
It's too much emphasis in the market, too much cost in the market, and not enough focus on the long run. And for the want of a better expression, you may have heard this before, staying the course. And so, it seems too simple. I know it's boring. And I tell people, we all have a little gambling instinct, I guess. And so put 5% of your money in a funny money account.
Yeah.
And check it every 5 years and see if it's doing better or worse. I'm going to tell you in advance that I believe you're going to find it's doing worse than just owning the market. Then give it up. If it's doing better, keep trying. But don't expect it to recur every 5 years because it's not going to. So we're all fooled by the market.
Yeah.
Fooled by the fact that it's only a derivative, one more derivative, of the value created beneath it by corporate America in this case.
Do you think the power of the market could be harnessed to solve some of these larger sort of environmental or resource challenges that the planet is facing in terms of the long term?
Well, absolutely, I think that. But I'm talking in that case not about the financial markets, but the capitalist solution or something.
Yeah.
Incentives to not do, again, carbon tax, for example, seems like a good idea.
Yeah.
It seems absurd. What do you have in Canada for gasoline tax?
We're paying about, if we convert it to a gallon, it's $1.25. So for about $5 a gallon.
How much of that is tax?
I'm guessing probably about 2/3 of it. Yeah.
That's probably right.
Yeah.
And we're paying last time I looked about $3.80 or $4.
Yeah.
And naturally, it's not for the premium. I wouldn't do that.
Yeah.
And the idea of a gas tax is so logical and so impossible to get the public to accept. So this is one case where you can't blame our wonderful politicians.
Yeah.
If people don't want it, they don't want it. Now, they haven't thought it through. If you had a chance to sit down one by one and explain it to them, it might be different. If you had some kind of a credit for those that were doing a lot of driving to work, for example, which we have to consider in all this, there are lots of variations on basic ideas that can be done to have the markets work in favor of less pollution, less global warming, and a whole lot of other things. Now, these things are, unfortunately, like the transaction tax is a good example.
Yeah.
Pagovian.
Okay.
And economists don't like Pagou.
Yeah. Mankiw was a big fan of him, Gregory Mankiw. Gregory Mankiw from Bush's first term.
Yep.
He's a big fan of Pigou.
And the reality is that one of the problems we have in this day and age, I guess a pair of problems, is that we've taken the transaction costs, frictional costs, out of investing. Yeah. It used to be 25 cents a share, and when you got to 100 shares, you just used a multiplier. It didn't go to 23 cents when you bought 100,000 shares. It was 25 cents. Can you believe that? Fixed commissions ended in 1974. And some Wall Street idiot, I was on a panel with him, Don Marin, the head of Payne Weber, I guess, said, if we unfix commissions, the market's going to go to hell in a handbasket. And in that case, the market did go to hell in a handbasket. But I think that was rather accidental. But it's transaction costs are down.
Yeah.
I should quickly say transaction unit costs are down. Transaction costs are up because there are so many more of them. And I tell people when Charles Schwab says, I don't know the numbers because I don't get into that, but we just reduced our price for buying 100 shares of stock from $20 to $10. They are not performing a public service. They're hoping to increase their revenues. They believe, I'm sure they got plenty of evidence for it, that if they cut the price in half, they will do more than double the amount of business. I mean, business is really pretty simple when you think about it.
Yeah.
So it's when you take those transaction costs out, and then the other thing, of course, is that with 70% of the market now being owned by financial institutions, none of which pay taxes. I want to be very careful about this.
So a few things I had handy.
Can you give me a 1-to-1?
Sure.
I'll show you the Bogle chart to go with it to make it much more dramatic.
Equity cap and GDP.
Hey, Mike.
pretty steady from 29, eh? I guess
Well, it's a little deceptive. We'll give you the ratios. Could you also get me that? Yeah, and we'll also do the relative to book.
okay.
And also, could you bring me in that chart I used in Bermuda with both the cumulative investment return and the cumulative speculative return?
Okay.
This will give you a much better idea. I'd leave the market cap one on top
Yeah.
for a sec. Market cap relative to GDP.
Yeah. And this is the other chart.
So you don't kind of pick that up without doing this.
So,
And you can, there's a fair amount of cyclicality in it.
So from almost half, a little more than half, to almost double.
Yeah, but you can. The numbers are, I think, they're upward sloping. That line, isn't it?
Yeah.
So you have to take that into account. I'm not sure exactly what that means, but if we did some kind of a mathematical formula, it would be beyond my competence. It'd probably look a little bit different, but still, it's amazing how that overvaluation in the year 2000.
This is the tech boom.
Yeah, that's the tech boom.
The internet boom right there.
Where was I when everybody needed me? They asked me on Wall Street Week at that very time, I think it was March of 81. I'm sorry, what advice I would give an investor. And I said, this is Roger McNamee, a West Coast venture investor. He was one of the panelists, a really nice guy. And he said, what advice would I give investors? And I said, the only thing I can think of to tell them, Roger, is to read Extraordinarily Popular Delusions and the Madness of Crowds.
Yeah,
Yeah.
it's one of my favorites.
Yeah.
The
Yeah.
tulip.
And I've now gotten to the age where I wonder about doing television or any kind of public appearances, because I am probably pretty damn close to the age where I'm going to say, Roger, I just tell him, go read, what's the name of that book?
Do you think humans, you've been, all your experience, do you think humans, my background is economics, so it's drilled into me, but do you think humans are rational? Do you believe in the rationality of the human species?
I think, as a broad statement, human beings are rational, sure, but with moments of irrationality, and moments, fewer inevitably, a number of extreme irrationality. And, the stresses of life, the stresses of the financial markets, the human existence is a pretty fragile thing. And I think we all take it for granted, by the way. And so there's certainly a rationality out there, but there is a lot of crowd psychology in it. We all know that from studies that have been done. Mm-hmm. And that if everybody else believes it, you're hard pressed to believe it. And that's one thing. Okay, I'll explain this to you. This is the now turn over to the book value.
Yeah.
Book value and price of the Dow. And it looks kind of harmless there.
So this is the Dow book.
And here it is.
Yeah. Well, you see the 2000 again, eh?
Yep.
That was right when I started my career covering financial news in September 2000.
And here, in a very simple chart, is what I think about the markets as derivatives. In my work, you probably read some of this. I look at investment return as the dividend yield at the beginning of each 10-year period, and I extend it over time, and the subsequent earnings growth. And speculative return is the change in valuation. Mm-hmm. And nothing could make it clearer that seeking investment return is really pretty smart, because a dollar grows to, looks like about $900, and a dollar in investment return and a dollar in speculative return grows to $1.
That's a pretty big differential.
It is.
How does it? So the red line factors out the dividends?
Well, it's just a change in PE
Okay.
over 10-year periods, moving 10-year periods.
Well,
But the conventional financial management industry,
can we have this?
Sure.
Yeah.
buy and hold has become conventional wisdom in the financial markets is that buy and hold is dead. Investors will be much better off, not following that strategy.
But understand.
I don't believe it.
Well, I mean, let me just say, tautologically, that is incorrect.
Mhm.
Because investors as a group buy and hold. Duh. Right? That's what we all do. We all hold this market or the market index, call it what you will. And that's all we ever hold. And what happens within that is we go back and forth among investor A to investor B to investor C and trade with each other. And it's got to be self-evident that trading with each other is a zero-sum game before cost and a loser's game after cost. So buy and hold can never be dead. To which I would add a little parenthetical, and that is buy and hold what? Now, we usually are talking about stocks, but I'd say buy and hold a balanced portfolio rather than buy and hold stocks. Not that I believe that a balanced portfolio will do better in the long run. I believe it will do worse in the long run. It almost has to. If you believe in the fundamentals of capital markets, the risk is going to provide higher returns as you take more risk. I wouldn't take too much more because I don't think it works at all levels. But it's basically a little insurance against behavioral risk is what you're dealing with. And and by the way, I should talk about that fundamental return just very briefly. Yeah. That huge drop in fundamental return is when corporate earnings got slugged in 2007, 8, 9.
Yeah.
Mainly the banks.
Yeah.
So it can happen.
They were 40%. They bloated to 40% of all earnings. So when they
and then dividends, despite what the problems with the banks, are higher than they were in 2007.
Yeah.
They're like $29 to $26 to $31, something like that.
Yeah.
On the S&P.
Yeah.
So I fall back on the fundamentals. I fall back on simplicity. I fall back on optimism. The whole thing is going to fall apart, and that makes it a pretty boring interview.
Well, it's pretty, but in this day and age, it's actually pretty radical.
Well, it is, and why is it?
Yeah.
Why is it so difficult?
Yeah.
I have a great quote in one of my books from somewhere, and it says, some of you had this philosophy, if I could only explain it thoughtfully, carefully, completely, then everybody would get it, and everything would be fixed. So, it's really nice to have the math on your side.
Yep.
And the math is irrefutable. I said, what is the intellectual argument for indexing? Gross return minus cost equals net return, and therefore if you minimize cost, you'll maximize net return. Pretty sophisticated stuff. And what is the argument, the intellectual argument now for active management? I can do better.
I can be the neighbor.
You can time the market.
I'm smarter than the rest of these guys.
Yeah.
But when you hear it from all 100 of the managers you're talking to, it must occur to you that all 100 aren't smarter. Although, given your ability to pick any period you want and information or any fund you want when you run, is that why Fidelity runs 260 funds? Somebody got to be, if they can't find a fund that does well, they have a real problem. But people don't buy those bananas anymore. Fidelity used to be $100 billion bigger than Vanguard, and now we are $1 trillion larger than Fidelity. But Ned is still worth $18 billion instead of $20 billion. He and his daughter. I don't know where the son is in all that. Hope he didn't get disinherited. Or do I care?
But you don't. Do you feel when you look, because your colleagues who founded $1 trillion firms, they're $10, $20 billion. Do you feel like you got short shrift, or
what is that? What do you say?
Like, do you feel like you got shortchanged because you started this firm that's worth $1 trillion? They started this firm that's worth less, and they're multi-billionaires. And you did done well, but from a financial perspective, a lot of people keep score how much money you have in your own bank. You don't feel like you missed out or anything?
Well, has that thought ever crossed my mind? Of course it has. I mean, what do you think? I'm some superhuman being? But, I did write a book called Enough.
Yeah.
And I have enough. There's no way in the world I could ever spend. you get to a certain point in life, which I'm certainly at, where you could not possibly spend the money you have in the remainder of your life. You could do something like buy a yacht, but that's more an investment than an expenditure. And I have no interest in buying a yacht. I wouldn't be able probably to afford the crew. I ran into a guy, this was some years ago, who wanted a transatlantic yacht. And so he has one. And I said, how many gallons of fuel oil do you have to put in here? Well, he gave me some number. And I said, my God, so when you go into the marina and say, fill her up, $25,000.
Oh, jeez.
Well, you gotta get across the Atlantic Ocean.
I want to give me the kayak. I want the kayak in that
Yeah.
case.
And and he seems to be very happy with it. But that stuff just doesn't interest me.
Yeah.
So you can't spend it. I could not spend it. But to make matters worse or better, I really find spending money, particularly spending on myself, utterly boring. I don't like to go into stores. I could tell you how old these trousers and this jacket were, or how old these loafers were, and I can't even remember, but I certainly have some suits in my closet that are 40 years old.
This is 40 years old. My great-uncle made it. Great-great-uncle was a tailor in Montreal.
Well, I hope he paid a gift tax. So, of course, you look and say, have I been treated equitably? And I think anybody that knew the data would say, you're not nearly treated equitably. But, I made the bed. I'm comfortable. If I wanted more money, it would be to give more away. And I do a decent job, and I did much better when I was making money, but I don't like to give away more than I have. And so, I'm satisfied. Mm-hmm. But every once in a while, with a little, I'm looking, who the hell is this guy? I mean, I'm just being honest with you.
Yeah. I guess most people wouldn't contest that you created a lot more value than you extracted, which is something that a pure at Fidelity maybe wouldn't be as solid.
Well, of course, that's the way the investment management business works.
Yeah.
Nobody can create more gross return.
Yeah.
I mean,
yeah.
all of us cannot create more gross return. So the more we take out, the less net return there is for all the investors out there. Which is just not arguable.
Yeah.
And, there will be things like R0, and he may prove to be right for more years, and he may prove to be wrong. I just don't know. Mm-hmm. I'm skeptical. I've always been averse to listening to really great salesmen, great marketers. Rob is all of that, and I want to be very clear on this. He's much more than that. He's a very, very smart guy.
Yeah.
He's written some great articles, some great studies, and he seems to have the statistical resources to develop stuff that every once in a while I wonder a little bit whether I shouldn't do it, but we just have me and Mike to do that work. Yeah. And Vanguard has a lot. They produce all these papers now. And we can afford to do that. We can afford to do any damn thing we want.
Yeah.
And the competitors look here and they're saying, there's nothing we can do. I have to say that. There's no way they can ever get to 16 basis points. And if Fidelity cut every single thing that they did, including Mr. Johnson's entire net income, they could probably get to 50. And when the consultant comes in and tells them, here's what you have to do, and Ned says, where will it get us? It'll get you to 50. Ned's going to say, for God's sake, that's still 225% higher than Vanguard. It's not going to do us any good at all. And that is the intelligent business decision. And that's what goes on in this business, the battle between your fiduciary duty and your conventional reading of business.
So maybe we like to leave before security gets us, and so you've been really generous with your time. But what's your goal? You seem to be full of vinegar and vigor still. What's your goal for the rest of your in the next 10 years or so?
Well, I think the chances I'll be around here 10 years from now is a pipe dream. I'm dealing with a lot of health stuff, and it catches up with you. Obviously caught up with me in my shoulder, and you lose a lot. And it gets a little harder to get around, almost embarrassingly so. And I don't want to outlive my stay. But as long as I have a singular voice, and it is a singular voice in this industry. You know, there's not another missionary here. This is a big business, and that's probably what it has to be. When you go from 28 people to 14,000, soon to be 15,000, and that's not my cup of tea. That's the way it is when you get big. When you get more and more. I used to say about this place, I've said about this place, and I say it again today, for God's sake, let's always keep Vanguard a place where judgment has at least a fighting chance to triumph over process. It's a losing battle when you get big. Nobody can argue that. You know, it can't be reversed. It can be moderated. And if you hate process, it can actually be withheld, but you need a lot of process. And I'm just not your great process guy. So I want to be here and available. I love to see and talk to our crew members. I spend a lot of time with them. I love to talk to our shareholders. This is pretty much me. Well, every once in a while, a daring flagship representative will bring a client over. We'll have a nice talk. I enjoy that a lot. And I'm over fully occupied. And I don't want to be over. I'll be very clear on this. I don't want to be as occupied next year as I am this year. And my wife's going to say, you always say that, but you never do anything about it. And she's furious at me today for, in my present, really quite weak condition. I promised to give a keynote speech at the 70th anniversary of the Philadelphia Analyst tonight. So she's just she thinks that's nuts. And of course she's right. But I agreed to do it before I got injured. And I'm not much on not living up to my commitments. And I think I'll be able to do it without falling down. Well, maybe I'll do it on a chair. No, I can stand up. I'll take a couple of Tylenol before I get up there because I'm a hurting. And I wish I hadn't do it. And I'd like to just, really, maybe work 4 days a week and then 3 days a week, something like that.
That's more than France. That's more than France.
Yeah, a lot more. And but I know that time takes its toll. My mind is not as sharp as it has been in the past at my peak, if there was such a thing. I don't think it's bad. I'll let you be the judge of that. And my energy and enthusiasm at the moment is terrific, but I used to sustain it all day long. And as I tell people, when I was waiting for my heart transplant, I had my first heart attack when I was 30 years old and struggled with it for a long, long time. A little backdrop, I'm trying to build something in the middle of all that chaos in the hospital a lot of times. And I got to the point where with my weak heart finally had to stopped working, that I used to summon my energy, and or my energy used to summon me. And in that difficult era of my life, I had to summon my energy. And you can only summon so much so soon. And it reminds me of that line from Shakespeare of Hotspur and somebody going out where the witches are. And one of them says, I can summon spirits from the vasty deep. And I think it's Hotspur who replies. And he says, well, so can I. And so can any man. But when you summon them, will they come? So when I summon it, will it come? I don't know. But I hope I'll be conscious enough to know that when I've outlived my usefulness, that I'll just kind of silently fade away like General MacArthur did, although he didn't silently fade away after all.
Thank you. We're really, it's really appreciative. It's great for us, and this is a highlight. We're really looking forward to this, and
I didn't mean to use so much of your time, and I've got a lot to do today before. I haven't finished this speech yet. It's particularly difficult.